Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning. It's Wednesday, the 10th of January. This is Peter Lewis and a warm welcome to Money Talk, the podcast that brings you the latest business news from across Asia. Thank you for making us one of the most listened to business and finance podcasts in Hong Kong, according to the pod statistics. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, the global economy is set to grow at its slowest pace since the pandemic, the World Bank has warned. Its forecast growth of just 2.4% in 2024, down from 2.6% last year, saying higher interest rates were a major factor. Global trade and investment will continue to be stifled by conflicts in Ukraine and the Middle East, it said. And the lender said global trade growth in 2024 was expected to be only half the average in the decade before the pandemic. United Airlines and Alaska Airlines have found loose parts on some grounded 737 MAX aircraft, threatening to escalate Boeing's problems after an Alaska Airlines plane suffered a mid-air blowout on Friday. United Airlines said bolts in need of additional tightening have been found during inspections of Boeing 737 MAX 9s. Operating profit at Samsung Electronics fell by more than a third in the fourth quarter, despite a rebound in chip prices. Still, this was Samsung's smallest year-on-year profit fall in 5 quarters, signalling a price recovery after last year's supply glut. Analysts expect a semiconductor industry recovery to gather pace this year on growing demand for high-performance chips. The world's largest memory chip maker estimated on Tuesday that operating profit fell 35% to $2.1 billion in an advance estimate for its October to December quarter. The Hong Kong government said on Tuesday it would seek an explanation from Cathay Pacific over the flagship carrier's cancellation of dozens of flights due to a pilot shortage. "We're very concerned," Hong Kong Chief Executive John Lee said. "We'll be in contact with the people in the aviation industry, particularly Cathay Pacific, to ensure that their capacity is rebuilt as quickly as possible." Secretary for Transport and Logistics, Lam Sai-hung, expressed his grave concerns to the senior management of Cathay Pacific over the airline's recent cancellation of flights. He said the cancellations are affecting Hong Kong's status as an aviation hub. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Tim Huxley, Chairman of Mandarin Shipping. With a view from Japan is Dan Kerrigan, CEO of Interactive Brokers Securities Japan. As always, if you want more business news from the Asia-Pacific region, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed mainly lower on Tuesday, giving back some of the strong gains from the previous session. The S&P 500 cut earlier losses as the tech sector rebounded. It ended the session 0.2% lower at 4,757. At its lows of the day, the benchmark had lost 0.7%. The Nasdaq Composite recovered from a 0.9% slide and was up 0.1% at 14,858. The two indices advanced 1.4% and 2.1% respectively on Monday. The Dow traded 158 points lower, that's 0.4% to 37,525, after being down as much as 310 points at one stage. Treasury yields were unchanged ahead of US inflation data later this week, with the 2-year yield at 4.37% and the 10-year yielding 4.02%. The dollar index edged 0.2% higher to 102.53, holding close to levels not seen since mid-December as traders await the key US CPI release on Thursday. The yen saw mild weakness, with the US dollar yen rising 0.2% to 144.5 against the dollar. In Shanghai, the dollar rose 0.2% to 7.1684 renminbi against the dollar. Gold was unchanged at $2,030 an ounce. Oil prices rebounded Tuesday from a sharp sell-off in the previous session as traders tried to assess the impact of a potential broadening of the war between Israel and Hamas and an uncertain outlook for global economic growth. Brent crude rose 1.9% to $77.59 a barrel. The Securities and Exchange Commission said Tuesday afternoon that an announcement about Bitcoin ETFs on social media was incorrect. Initially, a tweet purportedly from the SEC announced it had approved rule change applications to allow the first Bitcoin ETFs in the United States. However, an SEC spokesman later said the SEC's Twitter account has been compromised, and the unauthorized tweet regarding Bitcoin ETFs was not made by the SEC or its staff. In volatile trading after the announcement, Bitcoin was down 3.6% at around $45,400, having been up 1.5% earlier in the day. Trading in Hong Kong was muted ahead of US and Chinese inflation data later this week. The Hang Seng Index was up 1.2% at the high of the day, but stocks reversed course in the afternoon session, with the Hang Seng Index closing 34 points lower, or 0.2%, at a fresh 14-month low of 16,190. It was the sixth consecutive day of declines, marking the worst start to a new year since 2005, with cumulative declines so far this year of 5%. The tech index slipped 0.9% to trade at the lowest level since November 2022. On the mainland, the Shanghai Composite rose 0.2% to 2,893, but still close to a 20-month low. And it looks like Hong Kong stocks are going to fall further this morning. Futures markets pointing to a loss of about 106 points for the Hang Seng at the open, starting the day trading at around 16,084. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We're in the middle of the week already. Let's welcome our Wednesday morning guests. We have with us Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning to you, Enzio.
Good morning, Peter. Happy New Year.
Thank you. Happy New Year to you too. And also with us is Tim Huxley, Chairman of Mandarin Shipping. Happy New Year to you, Tim, as well.
Same to you, Peter. Good to be with you again.
Yes, very nice to speak to you again. When we last spoke, Tim, a couple of months ago, I remember we were talking about the shipping sector. We were talking about Maersk at the time, which was looking like it was in a bit of trouble, wasn't it? It was laying off workers, about 1/10 of its workforce. It was reporting sharp falls in revenues and profits. There was overcapacity, freight rates were coming down. That all seems to have gone into reverse recently. You've said many times this is a volatile industry, but this seems to be going from one extreme to another at the moment.
Well, Peter, yes, it is, but we've got to keep everything in perspective and everything in context. I mean, what's driving the attention the shipping market is getting, particularly from the media, is obviously the situation in the Middle East and the Red Sea, with these attacks that have been taking place on shipping. And indeed, probably one of the most notable attacks was actually on a Maersk ship. These are the Houthi rebels who have said they will attack shipping going through the Red Sea, which means it's the shipping that's going up to the Suez Canal, that major artery that handles 12% of all seaborne trade and about 30% of containerized trade. So it's a critically important seaway. But what has happened is that with some of the attacks, there have been about 24 attacks since the end of November on merchant shipping, fortunately without any notable loss of life or damage to ships. But what it has prompted is a lot of the major container lines are now rerouting their ships round the Cape. So they're going around Africa, which adds about 15 days to the voyage. And obviously that's an increased cost and it's increased time. And so that takes out capacity from the market. And what that does, like any market, you reduce capacity and you end up with a bit of a shortage. And so container rates for shipping a container from Asia to Europe, they have gone up by about over 170%. They've gone from sort of well below $3,000 to over $4,000 per container. So that's a big jump. And so people say, oh, this is going to be terrible. This is going to fuel inflation. There are going to be delays. Some of the big shippers like IKEA were saying, we will have delays. So could be a bit of frustration for flat pack furniture enthusiasts. But really, you've got to look at this in context. Yes, rates have gone up, but this is nothing compared to where we were in COVID. when rates were about 20,000 per container, where you had every link in the supply chain was stretched to the limits. You didn't have crane drivers, you didn't have truck drivers. Ships were held in quarantine. This is a sort of, the canal is not closed. And, let's just look at it in history. Suez Canal, it's always been this major artery. But you've got to remember back in the late 60s, the Suez Canal was actually closed for 7 years. We've had a small portion of ships now going round the Cape, and still plenty are going through. We don't expect this situation to be long term. Deutsche Bank came out yesterday and they said it would be a matter of weeks. That's a big, difficult thing to call, really, of making a judgment on warfare in the Middle East and geopolitics. But generally, people do think that this will be resolved. And of course, then you've got to also look at this in the context of the fact that you've got a massive oversupply of ships. Now, you've got 20% of the world fleet of container ships sitting in shipyards being built at the moment, and they're all going to be delivered over the next year or so. So that's not, this is going to, this hiccup in the Red Sea and Suez, what it's really going to do, it's going to help absorb some of this excess capacity, and all it's going to do is delaying the real impact of when that excess capacity, all of which was built on the extraordinary profits that container shipping companies made during COVID. And so they then ordered, and we've now got too many ships. So it might prompt some of the older ships to be recycled when that surplus comes in. But at the moment, yes, rates have gone up. And so anybody who's having to move goods, which would possibly be sent through the Red Sea and the Suez Canal, if they're doing it on a spot market basis and it's not under a long-term contract, then they will be paying more.
Enzio, this is having an impact, of course, not just on freight rates, container rates, it's having an impact on oil prices as well. But oil prices are really very volatile at the moment because there seems to be a lot of conflicting forces at the moment affecting that. We have, on the one hand, these disruptions in the Middle East, the Houthi attacks, but at the same time, there are countries like the United States, Brazil, which are ramping up production to record levels.
Yes, you've got clearly the Saudis who just on Monday actually cut the official selling price of February's exports. So they cut the prices of February's exports for the selling of oil, obviously. Then, of course, you've got this, what I call the U.S. wheelchair race, the presidential race, where the voters won't take kindly to a hike in oil and prices at the pump. So you'll probably find more crude oil production. But if I may just ask Tim one final thing before we veer away from the shipping a little bit. Tim, the China-Europe Railway Express has received some mention in the press. I wonder whether that's the Band-Aid to this hiccup that you currently see in the supply constraints.
Yeah, Enzio, the railway, yes, an amazing feat of engineering to get that built. But really, there is no real replacement for carrying goods by sea. You've got to remember, a train, yes, it'd take several thousand containers. One of these ships is taking about 20,000. So to replace that capacity with putting it on railways, it's really, there just isn't the scale.
Drop on a hot stone, yeah.
It's not really going to be enough.
Useful, thank you.
Tim, if we were to take out this current disruption that's going on in the Suez Canal, and also I suppose we shouldn't forget there's also some disruptions in Panama Canal as well, aren't there, because of climate issues. But if we were to sort of take that out, where would we be right now in the global shipping cycle? Is there still overcapacity there?
In container shipping, yes, there certainly is. And that's why the rates have come way down. What was it? The key indicator of the health of container freight rates is it's called the Howe Robinson Container Index. And last Friday, that jumped up 2.2% to 932. But its peak was in October 22, when it was just below 6,000. So that's the drop you're trying to make up. I don't actually see it going back to 6,000 unless, God forbid, we have another pandemic or something like that. Certainly it's going to take a very long time to absorb all of this excess capacity that we've now got. And when you've got these new ships coming in, it's always the great shipping perfect storm. You've got lots of new capacity coming on just when you've got declining demand. Seaborne trade, we're only predicting growth of 1% this year. So, we're in for a pretty long haul of quite a tough market.
But then at the same time, we hear stories and reports about, for example, that China can't get enough container ships to ship their electric vehicles overseas to Europe and elsewhere. So there seem to be sort of conflicting reports, don't there, about where exactly we are in the cycle.
Well, again, Peter, it's always the problem, isn't it, when you've got sort of 800 words to describe a complex economic situation. You're not going to get it all in that point. With EV sales, and there was this piece in one of the financial papers about the fact that there isn't enough shipping capacity to move all the electric vehicles that are being made now that China has stepped up to be the biggest manufacturer in the world. Now, certainly Chinese car exports have been phenomenal, and it's all led by EVs. And last year, they were about 4.4 million. And so they're now exceeding Japan's exports. And certainly if you're in Hong Kong and you've looked out over the straits coming into Hong Kong, you'll sometimes see these incredibly ugly ships that come in. They look like a floating block of flats.
I've seen some of them in Qingye, yeah.
They're car carriers, and they will carry about 9,000 cars. And they're basically just a big floating garage. You drive all these cars up a ramp, put them on there, and then the ship sails. But it's interesting how in China, about up to 40% of their car exports are actually done by container ship, as opposed to these specialist car carriers. And those articles that are appearing, we're all talking about there aren't enough of these specialist ships. Now, there are enough being built. People like BYD have now gone and ordered their own ships rather than using the ones by the dedicated car carrier companies, which are mainly based in Norway. So at the moment, the surplus capacity you've got in container shipping will help the car carrier market because they can put cars in containers and ship them. And then in the coming couple of years, in the next 2 years, you've got a very significant number of these car carriers being delivered, and we'll probably then go into surplus on that. So this is it's not really a big story of the lack of shipping capacity affecting EV manufacturers. What it is yes, it's more cargo, so it is helping alleviate some of the difficulties that you're seeing in the container shipping market.
So Enzio, when we hear about these stories about how much China is dominating the EV market and, is almost flooding the world now with exports, it's sort of that also rather sort of negates some of the stories we're hearing about the struggling Chinese economy. Or is it more that there are certain sectors of the Chinese economy that the government wants to promote and invest in, like batteries, like solar panels, like EVs that are doing well, but others that are doing really badly at the moment?
Yes, well, I think I would agree with the latter. I think that what's happened in China goes way beyond the rather simplistic notion if they just fiscally and monetarily stimulate. I think what's happened there is that something has come into play called party-state capitalism. And that basically means that the party, not the government, not the state, but the party, very much is at the helm of controlling which private enterprises are to do what and when, depending on what the party, not the government, but what the party wants. And I think that that's something that listeners need to be very aware of, because when economists come in there and say, well, if we just have a little bit of cut in the rate in the reserve requirement that we'll be talking about in a moment, these are ineffectual measures. They're a bit like giving an alcoholic a bunch of aspirin to take in the hopes that that will cure the headache. It just won't do.
The problem is, though, that as the government chooses these particular manufacturing sectors that it wants to invest in, It's going to trigger further trade tensions, isn't it? Because there's the domestic economy can't absorb all of this spare capacity, so it's going to have to be exported abroad. And the US and the EU are certainly not going to be very welcoming to that.
Yes, I think that this whole, and that's, of course, it's the confluence of events that you've got with that, and also then, of course, with this whole decoupling mess going on. So but I think there will be, my own, having covered US-Japan, US-China for a few years, played a little bit in that pen on the relations side, I do sadly foresee a lot of a very strong rise in trade tensions, China-US, because the electorate in America will be whipped up to hate all of those communist Chinese. Again, that's what they do over in the States, to appeal to the mass. And that isn't going to make things easier. And of course, all politics are domestic in China too.
So in this party-state capitalism, as you describe it, is there any room for the markets in that and market forces dictating where investment ought to go?
As far as I've understood this, and there was an excellent study put out just last year, no, there isn't. It seems as if very much as if the party will tell the sectors which it favors what to do, and they will have very strong influence, even just with a 1% voting right. They call those special financial shares or something of the sort. So I think that you'll find a very dirigiste economy coming back into play. And I don't know how then employment can be created sufficiently to employ this vast pool of unemployed labor. I just don't know how that's going to work if the market isn't allowed what it needs to do.
So how is it that we've ended up going from what was a form of sort of state capitalism, there was a form of market capitalism, to this party-state capitalism? Why have we made this transition? Is there some economic reason that Beijing believes is driving it, or is it really just purely a desire to have complete control over every aspect of the economy and society and everything else to do with China?
I think more of the latter myself. By the late 2000s, China did face a critical juncture in its reform process as the global financial crisis called into question the sustainability of its export-led model. But that doesn't mean that then the party itself has to take control of private enterprise. So I think it very much is Xi's desire to really have the party be more and more in control of China itself. So it's not, again, it's to differentiate between the government and the party itself. I think that's his new quest.
Tim, when you hear this, do you worry about the direction that the Chinese economy is going in, one where there doesn't seem or doesn't appear to be any room for market forces anymore?
Of course, all of us. I mean, since the 80s, we've always watched everything that's going on in China, and it has been the driving force of the global economy in so many different areas. And without China, we certainly wouldn't have had all of the developments we've had in the shipping industry over the last couple of decades. Just sheer scale of China means it is always going to be of huge influence, but you can't just sort of take one aspect of what's going on in China and sort of pin your hopes for the world economy on that. I mean, as Enzio has said, we've got all of this drama going on in the States and the rhetoric that's going to come out of there over the next few months.
Yes.
And that's going to be pretty ugly. But overall, you just go back. I mean, let's just look at what we were talking about earlier about, say, EV production. I mean, are we going to be producing too many electric cars? Is China going to flood the market? Is that market going to be destroyed? That could happen. I mean, we've got, slowing demand. And the questions about electric vehicles still remain. I mean, I'll put my cards on the table. I'm not a great fan of them personally, but.
And why is that?
Well, I have a sort of sideline on the side as a motor racing correspondent, so I'm more a petrol engine person.
They have also electric vehicle racing as well, though.
Well, yeah. But also, I think it's really important we've got. They're not the panacea to all of the emissions ills, and there are issues about how green they are about in the manufacturing, and also, I mean, Peter, you're in the UK. I mean, if you're trying to drive around an electric vehicle there, I mean, good luck on finding a charging point. So I think that there's still a lot of it's a great way forward, and EVs will play a role in decarbonisation. But going back to the sort of Chinese economy, it's you've got to get these people to work somehow. And I have every sympathy for the Chinese government in trying to get this employment issue and everything back on track. But what we've got to do is we've got to stimulate demand.
But they haven't created any new jobs, have they? For all of this, it's not creating new jobs because, for all this social engineering, the problem is there's just the economy is just not growing enough to put these people into work, and there's not enough domestic demand and consumer confidence to keep the economy motoring.
Without a doubt. And how you actually get people out there spending again. I mean, obviously, and it's all then interlinked. So people are worried about property market in China, and so they're holding back about spending. They don't want to spend money because they're now their children are not going out to work because there aren't the jobs. So there's a load of problems there that are going to take a very long time to solve. That's for sure.
I mean, Enzio, where does this report from the EU fit in about last year was the hottest year on record by a considerable margin, and the EU scientists warning that actually we're going to just blow through all the climate targets very quickly if we carry on like this. Does this put more urgency into things like electric vehicles and sustainability and environmental issues?
I think so, but it's also really consumer behavior. I mean, we were in Thailand and Phuket just over the weekend for the past couple of weeks, and it was appalling to see just this wastage of plastic that suffocates everything. So I don't think it's just these laudable effects that Tim also agrees with about having electric vehicles. I mean, they may not be, and as Tim says, they're not a panacea either. I mean, you junk up the environment by producing these things, especially the batteries, I believe. But I think that you're going to find it's also the consumer behavior that needs to change a great deal. And the weaning away from plastic, this dreadful material, and that is just not going to happen that quickly. But I would also have to say that we do have global climate cycles. For instance, I'm not sure if you're aware, I wasn't, that the Sahara Desert used to be a jungle. And I find that rather interesting, and that was, of course, way before plastic bags were even thought of. So it's not just the bad humanoid running around dumping his plastic everywhere, her plastic everywhere, but of course we have to do our bit to try and alleviate these cycles.
So what do you make of this World Bank report that was issued yesterday? They're saying the global economy is set for the weakest growth now since the pandemic. It's forecast growth of just 2.4% next year, down from 2.6%. And it talked about trade as well. It said global trade and investment is going to continue to be stifled by the conflicts in Ukraine and the Middle East. Global trade growth only about half the average now of the decade before the pandemic. Now, I know, Enzio, you're not a big fan of these multilateral institutions and their like the IMF and the World Bank and their economic reports, but nevertheless, is there anything in there that makes you think that somehow there's a wasted opportunity here?
Well, I'm not seeing it in the report itself. They tell the time by looking at somebody else's watch, and I just don't see where the value added is. But that aside, no, these multilaterals, it's all consensus economics time, and so I don't think that they really add a great deal of value to solving the problem of the wasted opportunity. I just don't see that happening. I myself think that there should be a massive push in middle-class education, especially vocational training. I think that would alleviate many issues of not everybody needs a university degree. I think that's at least one of my sort of clarion calls.
And also, we need investments, don't we? If the global economy is going to grow, we need, particularly developing countries, to be able to invest more. But that's, of course, very difficult with interest rates going up.
Well, China is to the developing world what the US is to the developed world. It calls the shots, basically. And so where China goes, I think it's safe to say it's a fair bet that that's where the developing world goes. And my outlook on China is particularly bearish, really, for some years now because of this policy, this party-state capitalism. So I think you're going to find a lot of polarization yet again globally in tension. So it's more than just this rather trite comment, well, interest rates have risen, so that's bad for everybody. It's more to it than that. And
Tim, this report from the World Bank is also talked about some of the things we were talking about a little bit earlier on, about disruption to key shipping routes, increasing the likelihood of inflationary bottlenecks. Anthony Blinken, who's in the Middle East, said these attacks have disrupted or diverted about 20% of global shipping, and the World Bank warning that this is all going to involve cost and time for moving things like food, medicine, fuel, and so on. So it all seems to circle back on itself, doesn't it?
Yeah, it does. But as I say, I think that, I tend to agree with Enzio about these various reports that come out, and it's very easy just to grab from them certain sound bites that generally look pretty horrendous. Most industries, and shipping being a particular example of this, they do actually have an ability to cure their assorted problems. And you look at, I think COVID was a classic lesson for us to realize how industries can actually overcome specific problems that do arise. And we had massive inflation during that time because we had a chronic shortage of shipping capacity. So, but we overcame that, and as is always the case, especially in an industry like shipping, we went completely the opposite way. The pendulum completely swung, and we went from massive shortage to chronic overcapacity, and that is the way of the world. And I think sound bites from various politicians and analysts and everything, just get down and look at the reality of what each and every one of our lives is all about. And that includes, how we're all living our lives about wastage and our own consumption of plastics. Just look at what you're doing yourself. And I think that we are going to come through this. This has been a pretty rocky start to the year, but I actually am pretty upbeat about the year as a whole, to be honest.
And that was the view at the beginning of last year, wasn't it? That people were pretty upbeat about certainly the Chinese economy, less upbeat about the US economy, and things worked out in reverse. Do you think maybe that people are being too gloomy about the Chinese economy for this year?
I think certain elements of it, you've got every reason to be concerned. But like last year, we were worried about, and again, this takes into account all of the things we've been talking about. Last year, one of the things that held up quite a few economies around the world was China's demand for raw materials. China was actually importing more coal and iron ore and everything like that. So this is not straightforward by any means about how it will be. And I think that China certainly, I think its raw materials this year, that's probably quite a strong performer. As we've seen, its exports on areas like EVs, that will be a very strong performer, but then it will lead to overcapacity, and so that market will pass.
Enzio, there was something in this report that caught my eye that maybe we should be concerned about, and it did highlight the difference in the recoveries in developed economies as opposed to developing economies. So at the end of this year, most people in developed economies are going to have a higher per capita income than they did before COVID. But if you're in an emergency economy, your income's about 75% of the pre-COVID level, and maybe 66% in the poorest countries, according to this report. That again is a huge lost opportunity, isn't it?
I think that's also a very dangerous one because of this of this polarization, which is as we all know, I'm not the World Bank, as we all know, is a very global sort of pervasive theme. And again, I get back to one, it's not a panacea, but one area is really middle-class education, vocational training. I really think that would at least give people some hope, because it's not really about spending, it's about job creation and thus job income security. That's what this whole thing is about. This whole economic scheme is creating jobs to create income security. And then once you have that, people will go out and spend. But that, my friend Tim, I'm not going to quite agree with. I am a little bit less optimistic this year, because I think the monetary cycle globally still has its way to go. US M2 only began contracting a few months ago, and that will continue for some time. So despite this cut in interest rate talk that the markets have been chattering about for so long, it's the real thing is to focus on the contraction of M2, which I think will continue.
So that means inflation's going to come down.
I think inflation will come down, but I think that the Fed will remain super cautious, having made so many mistakes on the way up. It will have to then at least temper its mistakes on the way down. Yeah,
I mean, it sees the bigger risk to the upside, doesn't it? That if it's wrong on the upside and inflation spikes, it's going to get into far more trouble than if it's wrong on the downside.
Yeah, especially with tight labor markets. But again, the tight labor markets are a supply side issue in my mind, that many people just don't want to work anymore. They only want to work a 3-day week. They only want to work they want to work mainly from home these days, so productivity goes down the drain.
Is that true, though?
All of these things.
Is that the case, that if you do work from home, that necessarily productivity goes down the drain? You're not as productive working from home as you are, say, in the office?
Well, as an analyst myself, I think that my productivity probably goes up because I've got the peace and quiet and no ringing telephones at home to get on with it, like you do with your work. But if you're part of a team effort, like a sales desk at a brokerage, I think you'd need that interaction with the other brokers, with the other traders, your old stomping ground, to then be productive. So I think that it depends again on the industries, as Tim would say.
Tim, where are you the most productive, apart from, of course, your local bar?
Oh, as you can see, I am in the office. I'm in a suit, 7:30 in the morning, and I am definitely an office person. I'm sorry, home is home, and I am more productive in the office. But it's not necessarily being in the office. It's actually being connected to people and talking to people.
Yes.
I mean, I was out at an event last night, and that was 500 people there till about 10 o'clock at night. That was really productive. But I think that it's, as Enzio alluded to there, it is actually this environment that you're in. And there are times when you do need peace and quiet. But for me, and I think in Hong Kong in particular,
yes,
it wouldn't work. It wouldn't work having everybody work from home or working in small flats and with all the family around there. And I certainly, talking to people who did long lockdowns in Europe of working from home, they said it wasn't as productive. You've got to talk to colleagues. You need those water cooler moments.
Okay, well, look, thank you both very much for a great discussion this morning. Some very interesting thoughts there. You heard Tim Huxley, who is chairman of Mandarin Shipping, and Enzio von Pfeil, who is capital preservation specialist at Financial Shield.
Peter Lewis's Money Talk.
I'm joined now by Dan Kerrigan, who is the CEO of Interactive Brokers Securities over in Japan. Morning, Dan, and Happy New Year.
Peter, Happy New Year, mate.
Thank you very much. Japan's Prime Minister Fumio Kishida, he seems to be in a bit of trouble, doesn't he, with this escalating sort of slush fund scandal. Explain a little bit for our listeners who may not be too familiar with what's happening there. What exactly is going on? What's this scandal all about?
Well, it's cynic's definition of history is always one damn thing after another, right? So just when we thought Japan was going to get back on the global stage as a geopolitical player where they should be, we're getting distracted by this latest bribery. Well, it's not a bribery scandal. What happened was that money in politics is nothing new in Japan. And it was just a bog standard fundraising event. And several of the leaders of the Abe faction within the LDP failed to report some donations to the level that they actually received. It's about $4 million, it looks like. But this is going to be something that's going to distract the Kishida regime from here. So just what's interesting, this is really nothing new. You go back to the 1970s, there was the Lockheed bribery scandal, which took down the Tanaka prime minister. And we also had a case in the 1980s of the head of Recruit handing out pre-IPO shares to politicians, and that damaged the Takeshita prime ministry. And what's just a little bit annoying about this is it was just a routine fundraising event. And I guess the Americans call it a rookie mistake. I think you would call it a schoolboy error, that they just didn't report the funds that they'd received. So this might be a sign that the Abe faction really thinks they might be above the law. They just kind of did this with impunity, not thinking that they were going to be cited for this. So it's just a shame because, as we know, Japan has made a large case for doubling their defense spending from 1% of GDP to 2%. We had, for the first time in about 10 years, a shipment of Patriot air defense missiles to the U.S. So Japan's sort of pacifist stance on things is actually changing a little bit. And it seems as though Japan's uniting with South Korea and some of the other Asian countries behind a common enemy in China. And the defense spending is something that we were watching very carefully. But I think in terms of really continuing that agenda, this scandal could be just a distraction.
Could it derail altogether those plans?
It's going to certainly delay them by the looks of it. But I don't think this is going to be a mortal blow to the prime minister here, to Ikeda. And we're not going to see the LDP have another internal election for the prime ministership until September of this year. And there's not going to be a general election until 2025. So I think it's going to slow down the agenda. It's unfortunately going to cause a little bit of stasis, which, again, that may or may not be a bad thing. But it's just an unneeded distraction right now. And again, it's a self-inflicted wound.
So you don't think the Prime Minister is going to have to resign or will be forced out as a result of this?
I don't think so. Well, if anything, because it just doesn't seem as though there's anybody in the wings waiting to take over at this stage.
And does it have an impact on the thinking of the Bank of Japan in terms of, when they exit their negative interest rate policy and their yield curve control? Is it in the back of their minds as well?
The bank always likes to say that they're independent. I don't think they're affected by poll numbers or politics at this point. I do think that they're going to be more sensitive to what we've seen with this earthquake in Ishikawa. I think it would be a little bit untoward for them to raise rates in the light of what's a reconstruction package. That's probably the priority in terms of the fiscal spending right now. Again, separate from what the BOJ is looking for, but that would just be another headwind to the effects that we're seeing of that earthquake. So I do not think that the Bank of Japan is going to raise rates. And certainly the activity that we've seen in the FX market is indicating that the spread between U.S. Treasuries and JGBs is going to remain where it is. We're back to the 144, 145 level that we had seen prior. So it looks as though there's status quo there, it looks like.
And we had some data yesterday for the Bank of Japan to focus on Tokyo's core inflation rate. It did slow, didn't it, down to 2.1%. In December. It was 2.3% in November. Still above the Bank of Japan's target, though, isn't it, for now the 19th consecutive month? But nevertheless, is there a downward trend again in inflation? I mean, we'll see the national... I
wouldn't say downward, no. I think the genie's out of the bottle, but I think we're going to stabilize around these levels here. But no, we're not going back to deflation from what we've seen.
Okay. Well, some good news. Despite all the problems for Fumio Kishida, it's not derailing the rally, is it, in the stock market? The Nikkei 225 closed at 33,763. That's the highest level since March 1990. We remember that, don't we?
We do indeed. So, yeah, I think that the markets are setting up fine. I think we've seen some interesting things happening that are endogenous. I think some of the takeover activity, some of the TOB wars that are happening are actually among Japanese firms. It's not like you have the outsiders coming in and trying to do takeovers. I think there's a lot of activity happening domestically, which is the thing I'm most excited about.
And I've got to ask you, can the Nikkei 225 regain its all-time high?
38915. I remember it well. I think we're going to be there. We will get, well, look, I'm not giving advice. We don't give advice here, but things are setting up for that to happen in the coming years.
Okay. And so if
just keep in mind, after the crash of 1929 in the U.S., the Dow Jones didn't recover its 1929 average until the early 1950s. Granted, it was a little bit of a different index, but it's been a long time coming.
Yeah, and I suppose that similar period of time, really, isn't it, for Japan as well. It was the best performing market in Asia last year, but the signs seem to be pretty good, don't it, for this year? It's picked up pretty well where it left off, whereas other global markets really have started this year sort of struggling.
So no, there's an interesting setup in the markets here, and I think a lot of it, as I said, is coming from capital improvements, capital efficiency gains, and a few other things. We're going to see an intergenerational change in wealth here demographically in the coming decades. So things are setting up quite well in Japan.
And what does this all mean for the yen?
I would have to think the yen is going to have to stay competitive. Some people are thinking it's going to significantly weaken. I really think that some of the trading partners in the region here would cry about that. But I don't see it coming back. Again, these things are in cycles, but it seems as though we've had a range over the last several decades that we're looking to break out of here. So this could be the new range, the middle of the new range. I don't see the yen really strengthening again. If there's anything of the Abe's three arrows, it seems as though monetary policy is going to remain loose.
And the Tokyo Stock Exchange, it starts this month, I think, its name and shame campaign, doesn't it, to try and improve shareholder value, boost those companies that are trading below sort of book value. How are companies reacting to that?
Some of them are getting on board and some of them are going to ignore it. But again, it all comes down to execution, because we've seen in the past some grandiose plans with the deadline. And then as the deadline approaches, they kick the can down the road. I don't think that's going to happen this time. I do believe the people who do run the exchange are going to follow through on this campaign. So that's exciting. And we're going to see people get on board, or some people maybe just take their companies private. There is going to be that debate here. Some people are going to say it's not worth it being a listed company. So we will see some take privates here, I think, in the coming years.
And there's going to be more M&A activity as well as a result of all of this, presumably.
Domestically, yes. Domestic and overseas. But I'm actually most excited about the domestic activity.
Okay. Is Japan benefiting also from the fact that it's not China? There seems to be this new asset class now of Asia ex-China, just like we used to have Asia ex-Japan sort of 30 years ago appear. Now suddenly clients are looking for Asia ex-China. Are you seeing Japan benefiting from that sort of trend?
I think we did see a bit of short-term benefit from that as everybody was heading out of the exits of China. But I think Japan ultimately is going to have to be evaluated on its own merits. And I think there's enough of a good story here where you can just look at this on a standalone basis. I think it's a left-handed compliment to say it's not China. Well, again, of course, it's never going to be China. The demographics, the population, the way businesses are set up, it's a completely different sort of animal at this point. So I don't really put a lot of worth into the argument that it's going to be benefiting over the longer term because it's not China. I think there's enough of a good story here.
Even though people in Japan don't want to compare it to China, there's many people in China comparing their situation right now to Japan and the situation it got itself into at the beginning of the 1990s with deflation and so on.
Yeah, there's some parallels with the demographics and with the indebtedness. But again, the difference is Japan didn't have military aspirations in the region, and it is, say what you will, the politics are a bit different. You can make your own argument, but it's not a dictatorship. So there are more differences, I think, than similarities.
Okay, well, it's going to be an interesting year for Japan. Look forward to talking to you more about Japan during the course of 2024, Dan. Thank you very much.
Thank you, Peter. All the best.
Thank you. That's Dan Kerrigan, who is the CEO of Interactive Brokers Securities in Japan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow when my guest will be Andrew Ferris, the CEO of Econosis Advisory, and Hong Kong-based macro strategist Patrick Bennett. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Please catch me tomorrow.
Money Talk